Let's talk about short selling for a minute. A lot of you ask me why I don't recommend short selling. So first of all, there will be years where you can make a lot of money short selling. I made money in 2008. I made money in 2001, 2001 during these massive bear markets. And no doubt I'll make some money short selling this year. Okay? But for the vast majority of investors, short selling is deadly. There is nothing more emotionally disturbing than being short the market when it's up 3%. The alpha crushing that's going on in your account is very hard for people to take. You're short the indexes, let's say, and they're up 3%. So not only are you not capturing the 3% upside, but now your portfolio, who knows, depending on how short you are, could be down 1 to 2% with the market up 3%. Now you've got 5% swing in your alpha. Most people can't handle that. And I feel it's my job at the ARMR Report to help you manage risk, not put you further out on the spectrum of risk. Okay? Short selling is as risky as it's going to get. You can find an idea you think is brilliant. Hey, I should be short selling. I don't know. Let's just come up with a ridiculous idea and say Netflix. That's a no-brainer. Let's short sell Netflix. And then you're asleep at night. You wake up in the morning and Disney is taking over Netflix. Comcast takes over Netflix. I don't know. I'm just making this up, right? At a 20% premium. You're screwed. You were absolutely right on your idea. Now you're stuck in a position that's gapping up. Okay. I'm not saying it's going to happen. Do you understand me? Are you with me here? There's unlimited risk. You could be short a biotech stock. You think it's going lower. Then some major biotech company takes them over at 100% increase. You see what I'm saying? There's unlimited risk. You can blow up your account that way. So you're never going to hear from the ARMR Report, which is all about protecting capital, that you should be out there on the spectrum shorting. Does it mean I won't short? No, I will short. And I generally like to say there's a step between long and short, and it's cash. So let's go look at the anatomy of a bear market. This is the rally in the market. This is the top. So the bear market hasn't started yet. The bear market's just gotten started. Okay, in the big indexes, obviously, all last year, the bear market was crushing everything else. But for the big indexes, right, the bear market just started. It's like a month old. Because if you go back a month, you're trading somewhere around the highs of an awesome bull market, and you're making a top. Now the bear gets underway. Okay, and so what I will be willing to do at this stage, now that I've got my large cash positions, and we've been carrying large cash positions most of the time since last December. Following the risk monitor, it's been red for most of the time since last December. We've tried a couple of trades here and there. We've made some money on a couple. We lost some money on the last one. It's the way it goes, right? But we've been basically in a large cash position for most of that period for our index-only portfolio. Okay? So we've gone from the long trade to the cash position, and now you're going to start seeing me short sell on rallies. Not here, not when the market's already dropped an enormous amount for the S&P in a 5-day window, but there'll be bounces. There'll be 2 or 3 day rallies back up to resistance, and that's when you'll start seeing me put out either short positions on the indexes, or I'll probably use the options market. You'll probably see me buying puts on the indexes. That's what I've done in the past, and I like doing that in times of a bear market like this. Market will run up, and what I look to do is on the huge up day, up to resistance, I start adding puts on days where, put premium comes down as people get excited that the market might be going up. Okay, so I'll look to do that, and then I generally will double or triple the position on the breakdown day. So I put on pieces it's running up, and then I start adding, I finish off my addition on that down day. And then I collect after the market implodes, rinse and repeat. So it's something I will be doing, but it's something I do not recommend most people do. Here's the reasons why. Number one, our job is to get on the right side of statistics and probabilities. And the fact is, in most markets, being short is on the wrong side of statistics. Okay, so maybe you want to say to me, this year is definitely a year to short. First of all, you don't really know that. You have macroeconomic guys that you listen to, and they've convinced you the market's going to crash. They don't really know that. Okay, so just stay nimble and don't fall in love with someone's opinion of where the market should go. Okay, everyone's got opinions where the market should go. Our job is to be nimble and to read and react. That's all. Not start predicting what we think is going to happen because there's some pundits we listen to that have been right for a couple of months. Okay. I mean, our risk monitor has been red for most of the time since December. Okay. We've been talking about this bear market for most of the time since December. But what I'm not going to do is predict what's going to happen next. I'm going to execute and read and react to what I'm seeing using algorithms because I know, and I've been through this before many times, right when you're convinced the market can only collapse, it will skyrocket on you. And you'll get blown out of your shorts. So if you don't, pun intended, if you don't short correctly, it's going to be a brutal experience. So first of all, you're usually on the wrong side of probabilities. So this year, there's some opportunities to be short the indexes, and certainly last year, other names. The reason I don't like to short, and I don't recommend it, is that when you start making, this is really the weird thing, but it's so true. When you start making money, ask me how I know this. I've been through it. I've done it. When you start making a lot of money short, your perspective gets skewed. And when the market does bottom and turn, you will not be able to make that shift. You will not believe it. You will convince yourself the market has to go lower. And you will either A, get roasted on your shorts, or B, what's happened to me in the past. I'm just sharing with you my experience. Take it for what it is. If you still want to short, I understand it. This is just cautionary tales that I hope make you think so you don't make the same mistakes I've made in the past. Okay? I hope you're better than me. But what I can tell you is I've made a lot of money short. The market's turned, and I booked my profits because you know me. I have stops and I book profits. But I stared at it saying, I think the market's going lower. I've just booked my gains, but there's no way I'm going to go long here, which was the very beginning of a massive up move in the market. And whatever money I made short was dwarfed compared to the size of the money I could have made coming out of the bear market. So short selling on an intraday basis, short selling on a quick swing trading basis makes a lot of sense, but don't let your mind become so far lost in the weeds of Armageddon that you miss the turn in the market. Because the opportunity cost of what you're going to miss will dwarf whatever money you make short. All right, that's all I have to say about shorting. So I'm going to be doing some of it. This is just a cautionary. So when you guys see me doing it, please understand where I'm coming from and look yourself in the mirror and say, can I do this? If I can't do this, then there's nothing wrong with just holding cash.